How much debt does a company like 8x8 have? It's a question that gets to the heart of a company's financial health and its potential for future growth. In a world where cloud communication services are more critical than ever, understanding the financial footing of a key player like 8x8 is crucial for investors, competitors, and anyone interested in the tech industry. We've all heard the phrase debt is a tool, and in business, that's often true. Companies take on debt to finance new projects, acquire competitors, or simply manage their day-to-day operations. But too much debt can be a crushing burden, making a company vulnerable to economic downturns or rising interest rates. It can also signal that a company is struggling to generate enough cash from its core business to fund its own growth. So, when we look at a company's debt, we're not just looking at a number. We're looking at a story about its strategy, its risks, and its opportunities. And today, we're going to dive into the story of 8x8's debt. We'll be pulling back the curtain on its balance sheet to find out the real numbers and, more importantly, what those numbers mean for the company's future. First, let's get the most recent figures. According to the company's latest financial reports for the quarter ending in March 2025, 8x8 has a total debt of approximately $410 million. It's important to note that this is a snapshot in time. The numbers can change, but this gives us a solid starting point for our analysis. But that's just the headline figure. To truly understand what this means, we need to break it down. We're talking about a combination of long-term debt and short-term obligations. And when we look at the company's long-term liabilities, we see a figure of around $392 million for the same period. This is the big picture, the money the company owes over an extended period. Now, a number like $410 million can sound big or small depending on what you compare it to. So, let's put it in context. One of the most common ways to do this is to look at the company's debt-to-equity ratio. This ratio compares a company's total debt to its total shareholder equity. Essentially, it tells you how much of the company is financed by debt versus how much is financed by its owners. For 8x8, this ratio is quite high, coming in at nearly 286%. What does that mean? It suggests that the company is heavily reliant on debt to fund its operations and growth, which can be a significant risk factor. But wait, there's more to the story. We also need to consider the company's ability to service that debt. This is where the interest coverage ratio comes in. This ratio measures how easily a company can pay its interest expenses with its operating earnings. A low number here is a red flag. For 8x8, this ratio is 0.6x, which is a major concern. It suggests that the company's earnings before interest and taxes aren't enough to cover its interest payments. This is a clear indicator of financial strain and a risk that lenders and investors would be watching very closely. Now, you might be thinking, this all sounds pretty bad, but a good financial analyst doesn't just look at the numbers. They look at the trends. Is the company's debt increasing or decreasing? Is it making efforts to improve its financial position? The answer in 8x8's case is a bit of a mixed bag, but there are some positive signs. The company has been actively working on debt reduction. Since August 2022, they have decreased their outstanding debt by approximately $234 million. This is a significant move that shows a commitment to strengthening their balance sheet. In fact, in a recent financial report, they mentioned repaying an additional $10 million on their term loan. They've also been strategic, securing new loans with more favorable interest rates to help with these prepayments. So, while the current debt levels and ratios are a cause for concern, the company is not just sitting idle. They are taking action. They are generating positive cash flow from operations, which is essential for any long-term debt reduction strategy. In a recent quarter, they reported cash flow from operations of nearly $12 million. This positive cash flow is the fuel they're using to chip away at their debt. But it's not all smooth sailing. The company has been facing a challenging market, and their stock price has reflected this. Over the last 5 years, the stock has seen a significant decline, and the last year has been particularly rough. While this isn't directly a debt issue, it's part of the broader financial picture. A struggling stock price can make it harder to raise capital through equity, making debt an even more critical and potentially risky tool. So what's the final verdict? 8x8 has a significant amount of debt, and some of the key financial health ratios are flashing red. However, the company is actively working to reduce its debt, and it has been successful in making substantial prepayments. They are also generating positive cash flow from operations, which is a vital sign of a sustainable business. The story of 8x8's debt isn't a simple one of good or bad. It's a story of a company facing financial challenges, but also actively taking steps to address them. The road ahead will likely be bumpy, but their recent actions show a clear commitment to improving their financial health for the long term. With that said, thanks for watching, and until next time.